Good morning, good evening, good afternoon, and welcome to the Booms and Bust Show. My name is Jonathan Davis, and tomorrow is the 4th of July, US Independence Day from Brexit, obviously. And you know, in America, they have this totally weird and I may say unique way of saying the date. July the 4th, January the 1st. Literally no other country in the world does it that way. But the funny thing is that on the day they got independence, or they started independence from, in that time, England, they call it the 4th of July. Kill irony. However, well done to them. They're having a long weekend party. Markets are slowed down as a result. There's no one around. We'll talk about that in due course. I want to welcome you again to the show where we talk about free markets and capitalism, and we rip to shreds socialism, cronyism, fascism, communism, Marxism, because they deserve to be ripped to shreds. Tweet me at BoomsBustsShow. Email me at jd@theboomsandbustsshow.com. And indeed, a few of you done so in the last week, and you've requested to go on the email list for the Booms and Busts report, which I would reaffirm because it's well worth receiving. In the Booms and Busts report, which I did a week or two back, it's still entirely current. I do it every couple of months or so. You will see a very clear case for why we may be going into recession over the next year. And it will be particularly useful to you if you're ever in doubt as to what to say to numpties who are saying everything is okay. You'll never be junk mailed. I want to thank Richard, I won't give his surname, who is a new subscriber to the Booms and Bust report. And he mentioned to me in his email that because I talked about some hassle I'd had from the RAC car breakdown service in the UK a few weeks back, he referred me to a company by the name of Auto Aid, which also provides breakdown on a national scale using local garages. And you can have breakdown cover apparently from as little as £43 a year. And that includes the full breakdown service and etc. If you want euro, you pay a bit more, fair enough. But it looks an absolutely superb service. Richard, you are the epitome, the personification of capitalism. You have found a service which meets your needs better than other services, better value for money as according to you, and you want to share that. And I'm very happy to do that. That, ladies and gentlemen, that listener is free market capitalism. I will just mention something that I was going to put in quote of the week, but I'll mention it right now. You know, one of the many manifestations of socialism and capitalism is the bread queue. Now, at this point, I'm going to remind you that there are pictures and charts on the Twitter feed at Booms Busts Show. And when I'm tweeting the iTunes link to the show, you will see attached to that tweet, you will see charts and pictures. So, socialism, you queue for bread. Capitalism, bread queues for you. And you'll see what I mean in the pictures. So, Richard, thank you so much for sharing that. That's very useful. I hope other people will go and have a look at AutoAid Breakdown, autoaidbreakdown.co.uk. There you go. Thanks again, Richard. Now, Anne-Marie Waters is a kipper, and she is standing to lead the United Kingdom Independence Party. She is the leader and I believe founder of Sharia Watch. Anne-Marie absolutely has her heart in the right place. And I think she actually should be the leader of UKIP. It's noticeable that every single one of their MEPs can't stand her. That says everything to me. And indeed, many on the NEC are trying to find a way to disallow her. They're basically trying to find out some way of showing that she's a racist. She is anything but. The thing is, she came out with her manifesto 2 days ago. It is now Monday the 3rd of July. It is 11 o'clock in the morning that I'm recording this. And I said to her, for weeks and weeks prior to her bringing out a manifesto, she needs to show free market capitalism. Otherwise, she'll be just like she used to be, a Labour activist. In other words, a socialist. Maybe she's moved a little bit towards free markets, but she's still left of centre. I read her manifesto, and okay, she talks there about entrepreneurs and small businesses, but she doesn't say anything about getting to solve the root problem, which is monetarism, central banking, cronyism, banking, the fact that we don't have Glass-Steagall, things like Help to Buy, quantitative easing, ivory tower setting the interest rates. She's anti-EU. She's wanting to sort out Islamofascism that we have. Well, I'm sorry. It's not good enough. It doesn't even come close, Anne-Marie, to sorting out the problem and therefore getting you votes and getting you seats in Parliament. Whether or not you become leader, you'll make no difference. That's the problem. Now, I just did over this weekend, I did our annual ritual of prior to our big annual summer holiday. We're off on the 31st of July. We're back towards the end of August, so of course I won't be doing the show for a few weeks. I guess I'll be back early September. I'm still here for the next few weeks. And what I did was, as I do every year, I go to the website of the house that we've taken for the month, and in France, in the just near the West Coast. And I copy and paste, and then I print off some photos from the website. So our girls get to see physically something about our holiday. And they could see the terrace, they could see the views, they could see their bedrooms, the lounge, and things like that. And it's a ritual that we do every year. And, from a free markets point of view, I want to point out to you that for the last several years, we've always found our big holidays, indeed our small ones as well, via Airbnb. Absolutely fantastic. Normal folk who've got either spare rooms or an actual house or a flat can go on there free and advertise to all and sundry globally the properties or accommodation that they've got for rent. And it's a very great website. It tells you all you need to know, and you can talk directly to the owners and all the rest of it, or at least do it through you can write through the website. Free markets, that's the first thing. So we cut out the middleman, the travel agent, and so on and so forth. That, first of all, cuts down everyone's costs. All they have to do is go on to Airbnb. This is the hosts, and it cuts down their costs, therefore. They can access people who are looking. But then, once we'd agreed, yes, this is the place we want, we'd agreed it with the hosts, we then went looking to see if it was on any other websites. We found it on another website without a booking charge. We saved another, I don't know exactly, 6 to 10%. Although we used Airbnb, they're not so smart. There are other websites who charge, in this case, zero, so we get the same accommodation for materially less. Free market capitalism. Did the socialists invent the internet? Did the socialists invent Airbnb? Did they? Hell. Just going back on something else that I've been talking about in recent weeks. I've been talking, of course, about the car business and how it's in absolutely dire straits in America. We're only 3, maybe 6 months behind in the United Kingdom. There you'll see a picture of an advert that Timmy O'Toole from Twitter put out. It shows a brand new Jeep Patriot Sport. Manufacturer's retail price, $21,760. It's available for $11,995. What an amazing deduction. A brand new Jeep vehicle for $12,000. That's what, £10,000? You're talking about a 2-litre with Bluetooth, voice command for £10,000. Brand new. Absolutely sensational. As I say, it's 40% off of the manufacturer's recommended retail price. Amazing. And it's because the auto market is in dire straits. We just saw some stats. US auto sales are on track to drop for the 6th consecutive month. This is no surprise. When you have such reckless lending, eventually it peaks. Eventually problems occur. People can no longer pay back the debts. They get their cars repossessed. They default on the debt. The lenders start cutting back on the lending. And as I say, in the UK, we're only 3 to 6 months behind. Which country has more tourists than any other country in the world? I'll give you a few seconds to think about it. Bing! France. Did you get it right? France, the biggest tourist hotspot in the world. And understandably so. We go there every year. It is absolutely sensational. We are Francophiles. The weather's amazing. The food is amazing. The things to do are amazing. The people, France would be beautiful apart from... No, we won't go there. But, you know, we're Francophiles. In fact, we're Europhiles. We are absolutely Europhiles. The continent of Europe is absolutely, utterly sensational. And in my dotage, I look forward, maybe, hopefully, possibly, to taking a mobile home around Europe for month on end. It's one of my dreams. It would be amazing. J'adore l'Europe. Je déteste l'Union Européenne. The two things are very, very different. But the interesting thing that I picked up on is that according to Figaro, which is one of the top-selling newspapers in France, interestingly, and this is the first time I've seen this in all the years that I've ever looked at this kind of thing, in 2016, the French had 1.3 million fewer tourists than 2015. Do you think it's possibly because people prefer not to be shot, blown up, or hit by a truck? It's possible, isn't it? Now, what else is happening in the world? I see Manchester University has got a new professor of economics. Now, this is an individual who told us that if we vote for BREXIT, the UK economy will absolutely collapse. The pound sterling will absolutely collapse. It will be the end of the UK. This was the guy who doubled the government national debt and told us all was well, and told us that he was a capitalist. I am, of course, talking about George Osborne, Professor of Economics. You really couldn't make it up. I was looking at inflation for my clients, and I was doing a bit of research. You know, CPI now is 2.9%. And incidentally, up until last year, what was CPI, they now call it RPIX. Well, you know, RPIX is now calculated, but it's no longer CPI because they changed CPI. If RPIX was still CPI, inflation would be 3.9%. So, you know, just because they changed the model doesn't change the inflation. They tell us inflation is 2.9%. Actually, according to last year's model, it's 3.9%. Worse than that, according to shadow government statistics, I think it's .co.uk, if you use the 1980 model for calculating inflation, inflation today is just shy of 10% per annum. This is how the politicians and the civil servants and, you know, those who just rule the country, and I'm not talking about Theresa May, this is how they lie to us left, right and centre. And I deliberately use the phrase left, right and centre. Look again on the iTunes tweet, you'll see a chart of shadow government stats inflation compared to CPI, which is a total, utter lie. There's an interesting chart moving on to of the US Treasury yield curve, which I'm about to explain, and how it compares to stocks and recessions. Now, look at the chart first of all. The grey columns are when the US was in recession. This goes back 50 years, so it's a lot of data. I'll come to the light blue line in a second. The dark line, almost purple, almost black line, is the US Treasury yield curve. In other words, it's plotting the interest rate that the US government borrows for 10 years minus the 3-month rate. And at any point in time, there is, of course, that differential. The 10-year rate minus the 3-month rate. And of course, the 3-month rate is very similar to the Fed's funds rate, or the base rate as we know it in the UK. In other words, the interest rate, the bank rate that everyone talks about. And it shows that since 2007, the yield curve, the differential, has been trending down. And we're looking at the dark line, the almost purple or black line, and as it stands, it's about 100 using the left-hand scale. Now, note that over the last 50 years, when the Treasury yield curve has gone negative, in other words, the 10-year rate has been lower than the 3-month rate. And why would it be? It's because the market believes that we're moving to deflation and or recession. Thus, the market's prepared to accept a lower interest rate in 10 years' time. Get it? Because with deflation, money will be worth more in 10 years, so they're prepared to accept a lower 10-year interest rate. When the difference goes negative, you can see that within months, the US, and therefore practically everywhere else in the West, goes into recession. Now, we're quite a long way from zero, from going negative. But we are trending down, and indeed more recently, we are pointing down since the beginning of the year, which means that we're getting closer to when we can say a recession looms. We cannot yet say a recession looms. Note as well that when it goes negative, that tends to be a major top in global stock markets. Very, very important chart. You should learn that chart off by heart, and you should keep an eye out on the Treasury yield curve. Talking about we can't yet see a looming recession, I see so many people, respected, successful market commentators, telling us a recession's coming. They might be right. And actually, professionally, I'd be extremely comfortable with that. But I don't know where they're coming from, and I think they're too early. They said it in 2016. They've been saying it all year. Jim Chanos, who is a brilliant market participant, unbelievably successful, he says the US economy is worse than you think. Well, I'm sorry, Mr. Chanos, not according to the global bond markets, who still have the Treasury yield curve, the differential between the 10-year and the 3-month, at 100 points. When it gets closer to zero, I'll be with you. But until then, dear listener, we cannot yet say that we have a looming recession. So whenever you hear or see or read the doomsayers saying a recession's coming, take it with a massive pinch of salt. They do not know. If they're right, well done to them. But I'll bet you, if you Google them for last year and the year before, I bet they were saying the same thing. No, the only thing you should listen to is the global market. There you have the sum total of market knowledge globally. Why would you listen to anything else other than the market? Socialism is an absolutely ugly thing. Look at the chart of Venezuela's inflation. It is running at 700%. The poor people of Venezuela are starving. They are being tortured and imprisoned. The 85% of them are devastated, and the 15% of them are living the absolute life of Riley, with the police and the soldiers fully fed, fully pensioned, fully paid, and they also living the life of Riley, raping and pillaging the 85% of Venezuela. This, listener, is socialism. And if you think for one moment, if anyone says to you, oh, it's not real socialism, I can tell you categorically, it's exactly the kind of socialism that every socialist in Britain and Europe and elsewhere dreams of. They tell us that socialism is the solution. It's the nirvana. Nothing could be further from the truth. And I raise the subject today, and by the way, if you want more information on Venezuela, just Google the hardships. It's absolutely heartbreaking. I raised it because I wanted to get across the message to you that when you hear people saying that we are going into recession and therefore the stock market will collapse, it may do. And it probably would do as it happens. If we went into recession, we'd probably go into deflation. So yeah, it probably would be bad for the market. But the economy is not the market. You know, just 2 years ago, the Venezuelan stock market stood at an index of 10,000. Can you imagine where it stands today, the Venezuelan index, with the abject economic depression that Venezuela is in? 2 years later, the Venezuelan index is at 120,000. Inflation. Inflation goes into the market. Now, that doesn't mean that people have increased their purchasing power, even though it's gone up 12-fold. What's that? 1,200% in 2 years. Absolutely in line with inflation. No, but it means that the small percentage of people who are close to the socialist elite, they at least have retained their purchasing power. And that is another reason why they're living the life of Riley. The rest of the folk, they weren't in the stock market. That's what happens, folks. That's socialism. Now, talking about inflation, the next chart shows the major interest rate that global markets look at to see the health of global bonds, global government bonds. The 10-year rate is the most important interest rate out there, apart from maybe the base rate, the Fed funds rate. Although I put the 10-year rate as more important. And when the 10-year rate, in other words, the longer term rates are falling, it means that the global markets are saying, we're going to have less inflation. We might even have deflation. We'll have lower economic growth. We might even have recession. When the 10-year rate is rising, inflation, probably economic growth, but not necessarily. So you've got the US Treasury, you've got the German, the Japanese, and the UK gilt. And look at that. All four of the major central banks of the world, I'm not counting the European Central Bank, I'm using the German for the proxy for the Euroland. All four of them are not just rising, but they're breaking up above resistance from falling trend lines. And although the resistance is only broken up in two of the cases a couple of days ago, in two of the cases several days ago, the fact is, if that rise sustains, and if is a very big, important word, if interest rates continue to rise, then you can say bye-bye to short-term deflationary worries. You can say bye-bye probably to short-term recessionary worries. You can see how there was a big breakup from last autumn, last late summer, And what did we see when interest rates rose last summer? Well, of course, we saw government bond prices falling. And we also saw gold and the various precious metals markets falling. And this is one of the reasons why I've been saying for weeks now, do not be bullish on gold, silver, miners, etc. I'm going to come back to that later. The breaking of the resistances suggests that the mild reflation, which actually started at the beginning of 2016, so it's now a year and a half old, it suggests that it continues. It might even get stronger, particularly if oil continues to rise. In just a week or two, it's risen from $42 to $46. You'll see it rising at the pump soon. So, very interesting. If that rising interest rate sustains, you want to be in inflationary assets in your pensions and investments. Exactly what I've been saying for months. Now, I did some research on trends in UK growth, because I've been saying that growth for the last 10 years has been averaging around 1% a year. Well, listener, there's the chart that shows it. It takes you back to 2007, and the grey horizontal line is the average for the last 10 years, just over 1% per annum. But look at the next chart. It shows GDP in the UK annual growth rate for the last 60 years. The average is 3%. And for the last, 15 or so years, the UK has had growth lower than the long-run average for about 75% of the last 15 years. And I tell you, I can't see us going back up to 3% for the foreseeable future. This is why I continue to say again and again, we are in economic depression. For new listeners, depression is not that the economy necessarily goes down like 1990, 2007. No, depression is merely an extended period of slow or no growth. And that's what we've had for 15 years. And when you consider as well, for the last several years, we've had a bit of inflation, not much, we've had inflation, and that's included in the GDP number. Take away the inflation, we've had very little, if any, growth. And then consider as well, we've had 200,000 or 300,000 people coming to live in this country. Shouldn't we therefore be having 5% per annum GDP? GDP is such a clunky, terrible way of calculating the strength of the economy, but it's the one that we have. The economy is going backwards as far as I'm concerned, but it's masked by debt. This is how dire the UK is. You think the pound has been falling for years because of Brexit? If you do, you're a numpty. How dare you listen to this show? Switch off immediately and start listening to James O'Brien on LBC. And only watch Simon, what's his blooming name? Britain's Talent and rubbish like that. Can't even remember the guy's name. No. The pound has been falling for years, if not decades, because our economy has been crap for decades. Look at the lack of economic growth we've had since the 1960s. way beyond the long run average. Sorry, way below the long run average. Very interesting, the Singapore Property Index. Look at the chart. It shows that for the last 3 years, the Singapore House Price Index has fallen from 150 to 136. Have you ever seen Singapore? It's 3 miles wide. It's got a population of 6 million. I think that's right, yeah. And it's rising rapidly. And its house prices are falling. For about the third or fourth time, do not tell me that house prices are determined by the number of folk. It's nothing to do with that. Or population density. It's nothing to do with that. It's all about easy money. House prices were going to fall off a cliff at the end of 2012. Then that bloomin' cronyist communist, George Osborne, brought out Help to Buy. Talking of house prices, there's been more and more articles I've seen in the British press about the negative state of the housing market. Last week I mentioned that The Guardian told us that buy-to-letters have gone down by a half. And I see this week the Daily Mail, Britain, quote, is on the brink of the worst house price collapse since the 1990s, unquote. Experts predict property costs could plunge by 40%. And who's telling us this? Paul Cheshire, Professor of Economic Geography at the London School of Economics. As soon as I saw that, I thought, hold on a minute. The LSE were these academic numpties who told us that if we Brexit, we'll get the 4 horses of the apocalypse and so on economically. I read the rest of the article and there it was. Professor Christian Hilber, also of the LSE, warned, if Brexit leads to a recession and or sluggish growth for extended periods, then an extended and severe downturn is more likely than a short-lived and mild one. How dare you? Brexit, A, has got nothing to do with the housing market, and B, it's going to be brilliant for the economy. You PhD, academic, socialist numpty. If the economy goes down, it will have nothing to do with Brexit. It'll be because of a global economic shock, a la 2008. There was nothing in that article which was worth reading apart from a chart which showed that since a year ago, when the rate of house price growth was running at 5.5% per annum. Well, that was actually, it peaked in September of last year. It's now down to 1.6% growth per annum. We're not even at falling prices yet. Well, we are in London. Both prices and rents are falling in London. London, where the market can do no wrong. Well, clearly, if that sustains, then yes, we'll go negative year on year. But, you know, a 1 or 2% fall is neither here nor there, especially after a few years of material growth. What we need is a global economic shock. That's when you get a recession. That's when, as I've been telling you, house prices will fall 25%. Now, should you go out and buy a house now? Absolutely not. You should be trading down now. It's a housing snake, not a housing ladder. you do what you want, but, you know, there are signs, clearly, facts, that the prices are slowing down. In some parts of the southeast, they're even falling. But we need a global economic shock for there to be serious house price falls. Markets. Very interesting chart of global wealth manager amounts of cash held in portfolios for the last roughly 12 years. When markets are doing well, particularly equities, and of course, wealth managers don't hold much cash. I say of course, because they're numpties. When the market's rising and rising and rising, they buy more and more and more. It's only when the market plummets do they sell. They buy at peaks, they sell at troughs. Don't think that wealth managers are any better than Joe Blogs on the street, and don't think that pension investment managers are any better than wealth managers. They're not. They could be, but they sell, they don't advise. They sell, which means that they do what they think they should do to obtain and retain clients. And when markets are going up, they buy, and the clients feel happy. And then they lose them all that money when markets collapse. And they say, oh, we didn't see that happening. That's how that world works. What you should be with are people who are contrarians, who sell when it's high and buy when it's low. Let's go back to this chart. So in 2007, at the absolute peak of the market, cash held was 11%. By the way, my clients in 2007 going into 2008 had 40% in cash when cash was paying 5%. By February 2009, after they'd lost all that money, wealth managers then sold and they went up to 21% cash. The market's been rising for years. They're back down to 11% cash. Think about it. Think about it. Now, the next chart shows the FTSE, and it shows from last August how the FTSE has been in a staircase, been going up and slightly down, up, slightly down, up over the last year, very healthily. You know, when it got up to 7,500, I was getting people on Twitter saying to me, are you still seeing 10 or 15% drop, Jonathan? I knew for a fact then that my 10 to 15% drop was in the bag. I started doing this show in early March, and I immediately said we're looking at a 10 to 15% fall in the stock markets. I was particularly focused on the S&P 500, but the other developed markets work just as well. And indeed, the S&P peaked at the end of February, and indeed the FTSE had a peak in the middle of March. And from the middle of March, well, take the S&P first of all. The S&P then went down, went up 1.33% over 4 months. The FTSE went from 7,450 to 7,600. What's that? 150 points out of 7,500. It's so tiny, it's not worth thinking about. And where is the FTSE now? It's now 7,300. And yes, the 10 or 15% spring, summer, fall is very likely upon us. And I've been saying also that the pound was strengthening. It's been strengthening for months. And again, when it was down there at the 120 against the dollar, I was saying Forget this Brexit rubbish you're hearing in the media. Forget what the banks and the economists are saying. The pound's going to strengthen. It's going to go up to the 130s, maybe even the 140s. And sure enough, it's up to the low 130s now. Bearing in mind, 9 months ago, there was massive negativity on the pound. And I was saying, no, it's done now. Buy the pound. The global stock markets are having a summer relapse. There are some who are saying that the recent highs presage a 2008 crash, which will take us from the summer of 2017 to the spring of 2019. They might be right. Nobody knows. All I'm saying right now, one step at a time, is that we're looking at 10 or 15% correction after a sizable rally. Then we will see a rally back up. And if we don't see a higher high, then we could possibly be talking about a serious crash. But we cannot even envisage such a thing until we see a lower high on the rally. Now, I've been talking about you buying uranium miners shares, locking them away, forgetting about them for years. Great news. I don't much care about this or that company announcing this. This or that uranium mining company announcing this or that. I don't much care about this or that government saying they're going to build a new nuclear reactor, or China, they're likely to build 100, they say, 100 by 2030. By the way, they've already got 20 in production. There's 60 in production globally. 60 nuclear reactors in production being built right now. They're not going to run on hot air. They're going to run on uranium. But I'm less interested in all that than what the market is actually doing. One of the greatest investors of all time, the Hong Kong Lai Ka-shing, has just doubled his investment in a major Canadian uranium explorer. That is the kind of news that makes me jump for joy. You can find the article on Bloomberg.com. When serious market participants are getting into a market for the long term that I'm in, I love it. And you should too. One thing I didn't say about the correction in the general stock market that we're talking about is it seems to me that there's a rotation from the FANG stocks, Facebook, Amazon, Netflix, Google, those type of companies, Microsoft. There seems to be a rotation from these hugely priced mega tech companies into energy stocks. Exxon, as in Esso. In Britain, you've got BP and Shell. And when you look at the sectors of the S&P 500, and there's about 10 of these sectors, whether it's financial or consumer stocks, tech stocks, energy, etc. And you can, if you look at the wider market, you only see one picture. Look at the individual sectors, and you see that the tech sector is a massive 17% of the S&P 500. It hasn't been this high since 2000. The dot-com? Well, it was much higher in dot-com. It was more like 30%, but 17% is the highest now in 16 or 17 years. Whereas energy stocks make up only now 6 or so percent You're talking about oil companies, natural gas companies. You're talking about the energy that we use, that businesses use every single day. And these are the smallest, they're at the smallest percentage share of the S&P 500 that they have been ever. Buy low, sell high. Which brings me to gold. And the next chart is a chart that I've knocked up showing the dollar yen. And you could pretty well overlay this onto gold, that when the dollar in 2016 crashed against the yen, so the yen got stronger, gold and its allies absolutely soared. In the second half of last year, the dollar soared against the yen. And what did gold, etc. do? Fell significantly. Now, the dollar has been falling against the yen for the first several months of the year. But look, since April, the dollar has been rising against the yen. Thus, another reason why I've been telling you to be bearish short term on gold, silver, the miners. Now, it is true that last week and this week we could be seeing erratic moves in markets because of the 4th of July. Everyone's on long weekends, they're not at their desks, so on and so on. I would imagine by Thursday or Friday, maybe even Wednesday, we might see directions taking hold. We will definitely see directions taking hold from Monday next week, from Monday the 10th of July. If over the next week or two the dollar continues to rise against the yen, you're probably looking at a number in gold that I've been saying since gold was 1260 and rising. By the way, gold today is right now is 1235, 1240. As gold was rising into 1260, I was saying then, in fact, I was saying it at 1295, gold's going down. It's going down around 1200. But as it was rising back up from 1245 to 1260, I was saying it again. 1200 plus or minus 30, by the way, we're within $6 of what I said when everyone was massively bullish. Sub 1200, you're looking at a major buy in gold, especially the miners. Major. Sub 1200, we could be looking by early next year or spring of next year, maybe even this year, we could be looking at 1600 on gold. And for miners, you could be looking at 100 or 200% on junior gold miners. The next chart shows the first 6 months of the years for various asset classes. The SPY is the S&P for the first 6 months, up 6%. Unfortunately, my printout is not very good, so I can't read it very well. The top performer is EEM, which is the Emerging Markets Index. TLT is long-dated government bonds, up also 6%. EFA is global developed stock markets outside of the US, ex-US, up a very excellent 14%. Emerging markets up 19%. So very interesting, the first 6 months of the year. Worth bearing that sort of thing in mind. And we are coming to the end of the show. And quotes of the week. packed a lot in today's show. I got through a lot, very pleased about that. Edward Snowden, perhaps the greatest American alive, who the authorities want to torture and imprison and maybe even murder. Very simple. Speak not because it is safe, but because it is right. And in a similar vein, from a couple of hundred years ago, from John Stuart Mill, let not anyone pacify his conscience by the delusion that he can do no harm if he takes no part and forms no opinion. I'm going to say that again. From John Stuart Mill. Let not anyone pacify his conscience by the delusion that he can do no harm if he takes no part and forms no opinion. And finally, I talked about George Orwell last week. It was the anniversary of his birth. I'm going to quote him again. You know, Orwell was a journalist, which got him writing about the road to Wigan Pier. And then he saw how the socialists turned against him, and he realised that socialism was a total utter fraud. And that brought him, of course, to 1984. George Orwell. Journalism is printing what someone else does not want printed. Everything else is public relations. It's now about 11:50 on Monday the 3rd. In about 15 minutes, I'll be on Radio 2 with Jeremy Vine talking about so-called austerity and the pay cap. Don't make me laugh. Government spending has risen every single year since 2010. So I hope you go on to Jeremy Vine's website or wherever it is, the BBC, and have a listen to what I said. Listener, on the 4th of July week, I wish our American cousins a very happy independence from England, from the United Kingdom. We are so looking forward to our Brexit from the fascist communists in Brussels, the European Union. Have an absolutely fantastic week, and I will see you next week.